Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
With us around the table is Stephanie Roth of Wolfe Research. Stephanie, good morning. Any reaction to this data so far?
Yeah, I mean, it's an interesting one. And like Mike just said, the weakness came from the Northeast, which is kind of interesting. It bounced back. It came weak after a strong month in September. There's just a lot of sort of noise going on in the data. I think what we're going to see is the housing market's going to have trouble bouncing back with mortgage rates having increased after even the Fed has been cutting.
Why do you think rates have been going up even though the Fed's been cutting?
It's all about the election, and it's all about the market. Certainly, the market trades Trump as a yield curve steepener. We've seen that to some extent. There are concerns about the deficit. I don't think that's the primary driver. I think it's the market's getting excited about a better growth outlook. And for 2025, I think that's fair. For 2026, I'm worried about the tariff impact on the economy.
Okay. I'm trying to understand this. So if yields go up, makes mortgages more expensive, makes it more difficult for people to afford homes because prices aren't necessarily coming down. At the same time, we saw confidence yesterday among home builders rise to the highest level going back 7 months. And this whole idea is, well, because of the election, regulations will get stripped back and the economy will be doing better than it otherwise had been. So which is it?
I think there's an element of this animal spirits coming back. So you saw for NHB, it was driven by expectations. Last week we saw Empire Fed increase a 3 standard deviation move. There's probably an element that people are feeling better about the outlook, right or wrong, but that actually has an important impact for the economy. And I think that's what's going to be driving an above trend growth for next year until we start worrying about tariffs again. Probably not till the end of the year.
But why do you think the worry for tariffs comes at the end of the year of 2026, when that is the one thing we know that Donald Trump can do unilaterally?
So our base case is that, one, he probably wants to play this game with a number of the different countries like he did last time, have a number of meetings, throw out the tariffs. We also think he'll probably want to attach it to some sort of investigation, which will require a comment period. And it makes sense for them to tie it to extending TCJA, whether or not they explicitly include it in a bill or there's a handshake deal about let's include the revenue savings for this bill. It makes sense for them to do it around the same time.
If they're connected to the tax bill, what is the true objective of these tariffs?
I guess it depends who you're asking. I mean, I guess from Trump's perspective, there's 2 benefits. I think they're pretty risky, but from his perspective, there's 2 benefits. 1, you can stick it to China, and 2, they can raise trillions of dollars on these tariffs, at least the way if you assume sort of static estimates here.
So you see both the good things and the bad things that the market has to digest when it comes to Trump policy being connected in terms of he wants to extend TCJA, he wants more tax cuts, and he's going to say, I'm going to pay for this with tariffs. So they all get rolled out at the same time. So the sequencing is actually in parallel.
Yeah, kind of. I think for now it's a better growth outlook for 2025, better confidence, and then we start getting into the 2026 tax cuts, and then I think it's a negative for the market because at that point it's tariffs, and by the way, the tax cuts aren't really that large, right? They're expensive, but it's really just extending current policy. The incremental tax cuts that we're projecting is something like $500 million, which isn't that big. It's things like no tax on tips or a very narrow corporate tax rate cut, which is really just for domestic manufacturers. The rest of it is just a very expensive bill to extend TCJA, which is not a stimulus for the economy.
So before we get there, and going back to home building, because I'm still trying to wrap my head around, okay, you've got the tariffs and how this affects inflation. I'm trying to get back to, does this cause a revival in the housing market at a time where everything that you just painted does not suggest interest rates going down that much at the long end? Can you see a revival in housing, in some of the basic staples that people have been basically complaining about that they don't have access to? Can you see a revival if you have mortgage rates that stay at these levels?
Probably not. It's a tough one. I think the part of the economy that's going to do better is on the CapEx investment side. So less about housing. I think mortgage rates are still going to be a bit of a headwind. Could see a bit of an improvement. The builders are excited from the regulatory front, and that's fair. But I think the bigger stimulus for the economy is going to be on the corporate investment side, because that's where the deregulation is going to be important and the sentiment is absolutely critical.
Before you go, December, pause or cut?
It's a tough one. Base case is that they're going to cut. But I think it's fair for the market to be pricing 50-50. The most important thing is going to be payrolls. And we'll get a hint of that today when we get state employment at 10.
Payrolls coming out a little bit later, December 6th in the next few weeks, and then December 11th for CPI. That Fed decision December 18th. Stephanie, good to see you.
Good to see you.
Thanks for catching up with us. Stephanie Roth of Wolfe Research. Let's have that conversation right now with Joe Feldman of Telsey Advisory Group. Joe, welcome to the show. Following those numbers from Walmart, I'm going to steal Lisa's question to kick off the conversation. What is Walmart these days, and how much has that company changed?
Yeah, so Walmart is a terrific retailer that's grown its ecosystem, and it's much more than just a retailer these days. I think, they have become more similar to what an Amazon is in terms of offering, a marketplace, offering advertising, and effectively selling across the board online, in stores. And they've grown their whole ecosystem as a result. They've been able to capture a more affluent consumer. They're still satisfying that lower income consumer that needs the low prices on a day-to-day basis. And so they're really serving the American customer very broadly right now. And this quarter was very strong, and I think it just shows those results.
Yeah, Walmart's online sales now represent about 18% of the company's business. They also have things like coupons for loyalty members to places like Burger King. I'm just wondering, Joe, if there is still the read-through from a Walmart results to the rest of retailers. Do we get a real sense of the consumer and the health they're in?
Yeah, no, I do think there's still a good read-through. I mean, Walmart is still the largest retailer in the world, and, they are still, especially in America, the largest, and they're capturing customers day to day. I mean, around 2/3 of their business is groceries, and so they're seeing that customer come in once a week, and their grocery business was up mid-single digits in the Walmart U.S. Operations. So the customer is still coming in on a regular basis. They're seeking value. Their private brands have done well. As I said, they've captured a more affluent consumer. So it just seems like, I do think it's still a good read on the broader consumer. But what's really interesting here is they do so much more now than just sell stuff out of the store. And I think that's what's gotten investors very excited. And you can see the strength and the market share gains that they've had with the reports that they just did this morning.
Is their gain taking away from Amazon, or is it basically taking away from Target, from all the other retailers that are a bit smaller and less advantaged than they are?
Yeah, I think that the big guys kind of go to battle with one another, but the share gains are coming from all those smaller regional local players. I think that that's where you still see a lot of it, because Amazon's operating quite well. I mean, they have very good earnings recently, and they're expected to have another good fourth quarter. I think Target's been operating quite well. We'll see tomorrow for sure, but I would expect, some similar directional trends that we got out of Walmart today. But it's really, as you go down, the dollar stores have been under a lot of pressure this year. A lot of people believe that the Walmart's taking share from some of the dollar stores. I think that's somewhat true. Again, they are capturing a more affluent consumer, so that's coming from somewhere, maybe the traditional grocer out there. So the prices are so good at Walmart. They're so sharp. And what's amazing is they're driving their business with increased traffic, increased unit sales. Those are the good things you want to see. It's not just ticket. Ticket's part of it, but it's really because they're getting more people in the door more frequently.
Joe, I want to talk about strategy. Is the new strategy to start Christmas shopping in October next year? Is that what we're going to be talking about?
Yeah, I think we may be already happened this year, quite honestly. I mean, with Amazon Prime Day back in October, and then Walmart did an event right around it, Target did an event, Best Buy, everybody else in retail tried to capture that week. And, we've been seeing Black Friday ads for quite a while now. And, it started to kick in even a little bit more just yesterday. We noticed a lot more emails and pushing that. So that holiday season has definitely gotten stretched out. Now, this year's kind of unique because there are 5 fewer days between Thanksgiving and Christmas. So that does compress the season a little bit. And I think that a lot of the retailers tried to take advantage by elongating it on the front end. But it just seems to us that you're going to see this continue for some time now, where mid to late October is when things start, really, for the holiday season.
Joe, we're all living it. We're hearing the music. We started hearing the music about a month or so ago. Joe, I wanted to talk about a theme that we've been discussing on this program for quite a while now. It's how battle-hardened, how battle-tested these companies have been, the retailers, over the last, let's say, 8 years. They had the pandemic in the Trump first term. President-elect Donald Trump will get a second term. They could face the same again. The tariffs, the pandemic as well. When they manage inventory, Joe, how have things changed over the last several years for these retailers, given the tests that they've had, the unique tests over the last decade?
Yeah, one of the biggest things that's changed is that the supply chain finally normalized in the past 2 years, let's say. And as a result, the retailers have been able to get back to more of that just-in-time ordering. And we've seen the inventories be run very lean, really, for the past year and a half for many of the retailers. You saw that again today, even with Walmart, where they don't need to necessarily order early. Now, when events happen, like, the East Coast port strikes that happen, and by the way, we haven't resolved that. The contract has not been signed, and next round is January. The retailers did bring in inventory a little bit ahead of that. I know there's concern if and when the new tariffs get put in place by the new President-elect Trump. I think, there is some concern that we might see some inventories get accelerated prior to those tariffs. That makes sense. The retailers have definitely gotten smarter about how they're ordering, where they're ordering from. They've shifted their distribution or their supply chains beyond China. They're much stronger in other parts of Southeast Asia at this point and other parts of the world. So there's a little less reliance than the first go around with the tariffs back in 2018, 2019, but it's still going to be a big pressure, and it's going to likely pass on to the consumer. And we see it as somewhat of a tax on the consumer, quite honestly, because it's likely to raise prices. All the retailers are telling us they're going to have to raise prices at the end of the day. Maybe not for the full amount of the tariff, but definitely for a good portion of that. And we see that as an inflationary impact as well.
Joe, just to build on that, there is this feeling, and every time we see a tariff announcement, retailers sell off the most, and they're viewed as sort of ground zero when it comes to potential companies that are most exposed to tariffs. Are you saying that maybe that's already baked in to some degree, and that people have basically prepared for that, and these retailers have already plans in place to offset that?
I think the retailers, the better ones at least, have definitely been planning for it. It was interesting, the day after the election, the way the market traded, and I know there was the Trump trade and everything went up. I think the market was up 2.5% that day. The retailers that have more exposure to China were down that day in a pretty big way. And so you saw that initial reaction. So I think the market is already starting to think that way. Who has more exposure? Where do they have to lighten up? But we cover quite a few companies that, there's an example I have where, several years ago they had 50% of their product coming out of China. Today it's 20. Actually, it's probably getting close to 20. It was 25% last year. It's probably 20-ish this year. So you've seen the retailers move and reposition through the past couple of years, and I think we'll see more of that accelerate over the next 6 months.
Hey, Joe, it's good to hear from you, sir. Good stuff. Joe Feldman there of Telsey Advisory Group. We begin this hour with equities lower and bonds rallying as Ukraine carries out strikes in Russia using US weapons. Joining us now is Emily Roland of John Hancock. Emily, welcome to the program. I want to turn to a quote that came from Laurie Calvasina of RBC to kick off the trading week. And she said this about valuations and positioning and sentiment, that the US equity market seems to have little capacity to absorb bad news. What have we learned this morning on that front?
Well, we've seen a modest bid, John, for some of the geopolitical hedges out there. You're seeing the dollar strengthen. You're seeing gold catch a bid here. Notably, oil prices are still looking at WTI below $70 a barrel. So we saw a big move, of course, yesterday. That's moderated a bit today. And then, again, a modest bid for treasuries here. I think the treasury bond market has been focused on nothing but the potential for pro-cyclical policies under the Trump administration. So you're seeing a bit of a shift here, but certainly nothing that's overly notable here, given the prospects for heightened geopolitical risk.
When you think about all these issues on the table at the moment, Emily, it just feels like it might be US-driven. In this case, a decision to allow Ukraine to strike Russia inside Russia with US missiles. But it's Europe's problem. Likewise with tariffs. Tariffs ultimately Europe's problem. Does this just reinforce the view of US exceptionalism into next year?
Well, certainly that's what markets are telling us. You know, we've seen massive outperformance from U.S. assets here. Again, that dollar strengthening trade. We've seen this almost speculative frenzy across risk assets in the United States, everything from cryptocurrencies and crypto-related assets to lower quality growth stocks. I think one of the things that we need to think about here is the consensus around the U.S. is so overwhelmingly positive right now. And when the consensus moves to one side of the boat, sometimes it can flip. So we want to think about, you know, potentially fading some of the move that we've seen into more speculative assets and redeploying assets into higher quality, more defensive options here, given the massive run that we've seen in more speculative assets.
So, Emily, sell Tesla, buy 10-year Treasury yields?
Well, you know, I think you got to own some of that stuff. You know, Tesla's certainly come a long way. You know, we look at, of course, the big event after the close tomorrow with NVIDIA's earnings. NVIDIA is the #1 high quality stock. So we want to continue to embrace quality, and that's according to quality indices that we look at. We want to look for companies with great balance sheets, good return on equity, a good ability to maintain margins here. But I think the name of the game right now is really quality at a reasonable price. How can we think about embracing those quality companies but not overpaying for them? And so we're following the earnings. It's going to be really interesting to see if NVIDIA can once again deliver tomorrow.
Are we underestimating how much of a macro story NVIDIA is going to be? That basically this could be the main event of the week in a pretty significant way to send markets in a direction about if they can raise and beat in the same kind of way.
Yeah, I mean, I think it's just because of the sheer size of the stock, it's got to be critical. You know, I've been spending a lot of time with investors over the course of the last few weeks contending with some of the issues around, for example, emerging market equities and what to do with those positions. I've gotten a lot of questions about, you know, India, for example, and we've had those conversations, but it's like, look, NVIDIA is 20 times the size of some of these markets. So that's why it's so critical here to portfolios. Again, we want to be there because the earnings have delivered and it's high quality. But we've got to think about diversifying that exposure and finding areas of the market that are still going to give us quality, mid caps, industrials, for example, but that actually are trading at more reasonable valuations.
Emily, in your notes you talk about, and you're talking about here, that you push back against this consensus, this idea against higher inflation, higher growth narrative. Yeah. Then what do you look at when you think about these policies that potentially we're going to see next year, which many say they actually could be inflationary?
Well, Anne-Marie, I think potentially is the right word. And I think a lot of us have been saying the word potentially over the last couple of weeks here. You know, we looked back at the last Trump administration, and yes, there were some different dynamics from a macro perspective, but core PCE, which you know is the Fed's preferred measure of inflation, averaged 1.7%. In the last Trump administration. If these tariffs are more targeted, you may see the impact to inflation be much more muted, maybe 0.1% per a lot of the economists that we've talked to about this issue. The impact of these potential immigration issues actually are going to possibly weigh on growth. So we're looking at some of the things that the bond market's really not sniffing out right now. For one, wage growth is coming down meaningfully. Job quit rates are down, which should put downward pressure on wage growth and corporate profits. Housing supply is increasing significantly right now, which should cause that tricky shelter component of inflation to finally moderate in our view. And then the commodity story, which we mentioned earlier, if you're expecting some kind of 1970s boom in inflation, that has to come alongside higher commodity prices. And we simply aren't seeing it now, especially given more muted demand out of China. So we think every backup in bond yields represents a nice opportunity to lean into the income that's available, which is now close to 5% on the aggregate bond index.
Two policy proposals you didn't mention I'd love to get your view on. The idea of we're going to see tax cuts at the end of next year, and also that this is a president that wants to see deregulation throughout the Washington complex.
Yeah, so the deregulation story, I think you're primarily seeing in the outperformance of financials. Regional banks are on an absolute tear. Same thing happened post the 2016 election. That trade lasted for a couple of months after the election and then basically moved sideways. Not to say there wasn't value there, but really the bulk of the outperformance came on the news. You know, we're also looking at corporate tax cuts potentially, and that was very accretive to corporate earnings. If you look look at the S&P 500 next 12-month earnings growth, you saw a spike in 2017 once those tax cuts went through. So I think investors are betting on that. The challenge is a lot of this great news, whether it's continued stock prices running, whether it's the economy doing well, a lot of that is in the price on the equity side, with the S&P 500 trading at about 22 times forward earnings, 27 times trailing, which is as expensive as stocks have ever been, third most expensive in history. So we want to think about the fact that, can we get much more multiple expansion? We've just seen a massive bull market that was all driven by multiple expansion. Earnings have actually gone pretty much nowhere over the last couple of years. That's the reason we're thinking about bonds. We don't think that they're priced appropriately for what comes next. Stocks are already there.
Emily, I have to say, what I'm hearing from a lot of different investors is a desire to try to get out from under the whipsaw headlines of, the Treasury Secretary race and whether we will get tariffs and how much or how not to, and all of these kinds of things, and figure out what you can lean into that's just sort of a constant. Is that basically what you guys have been doing? How do we strip out the signal from the noise and really figure out our strategy independent of what some of these policies might be?
Yeah, and Lisa, you're right. It's tough, and it might be a little boring to people to kind of try to stay away from some of the conjecture and think about what really drives markets over time. You look at some of the relative performance under the last two administrations, and it's actually exactly the opposite of what you might have guessed. For example, under the Biden administration, the best performing asset class by far has been energy. Probably not what you would have thought given the green energy policies that have been put in place. Under Trump, the first Trump, one of the best performing asset classes you could have owned was Chinese stocks. It's because we were in a period of global synchronized growth. That macro story was far more important than what was happening from a policy perspective. So we think if you can try to cancel out some of the noise, focus on earnings trends, focus what's happening from an economic standpoint, that's going to lead you to a better path forward as far as cross-asset performance.
We did just get Walmart earnings. We get Target tomorrow. We also get NVIDIA. We've talked about NVIDIA. Other than NVIDIA, is there an earnings story that you think is kind of a North Star of some sort of signal versus just simply noise?
Well, I think it's really about the broader story here, and the bar is just going up. Analysts are penciling in 15% earnings growth in 2025, and we think that's an awfully high bar given the fact that we're seeing decelerating growth trends. It doesn't mean that there aren't pockets of the market that can achieve that, but you've got to be really, really mindful here in terms of reaching too far for risk. And again, embracing those higher quality, more defensive options. We like areas like utility companies. We continue to like technology companies at a reasonable price. It's really about that internal market rotation and, frankly, finding an active manager that can identify those stories.
Emily, appreciate your time this morning. Thanks for catching up with us. Emily Roland there of John Hancock.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.